Hello and welcome to this week's edition of Invest Africa. I'm Alicia Second. Well, for those wanting to access opportunities on the African continent, risk is often cited as a key challenge. This week, we unpack the African risk landscape and discuss how it can be managed and mitigated in the process of doing business on the continent.
The African continent is perceived to be the world's greatest opportunity for corporate expansion. However, lack of proper risk analysis may mean that organizations have been unable to maximize reward and have either underachieved or failed in their African expansion plans.
Africa requires that you have to be so savvy, you have to be street smart. You can't just be, sit without being belittling the corporate executive. You have to understand what happens at an operational level. It's when you understand that business in Africa becomes far more tangible and profitable.
Economic risks ranging from weak policies, high taxes, talks of nationalization, inadequate infrastructure and red tape are common obstacles. But according to John Saker, partner for advisory practice at KPMG, understanding and operating in a specific market first may minimize these risks.
So the thing in Africa is you need to be specific to a jurisdiction or at best to a region, the lake districts or the lake areas of East Africa or Francophone West Africa or Equatorial Africa or Southern Africa. So there needs to be some specifics in this regard.
In some jurisdictions, there may be legal requirements such as citizen directorship or ownership. Changes in the structure of such regulations may present uncertainties that may deter investors. But according to the Insomnia Index report, political risk still ranks among the biggest challenge to doing business on the continent. Africa is slowly moving forwards towards political stability, especially when taking into account that between 1960 and 2000, Africa experienced some 85 coups d'etats, contrasted with only 10 in the last decade. Rwanda is just one example of an economic success story post-political conflict. Political leaders are making inroads in establishing the continent as an investment haven and less of a risky business endeavor. Dumisha Machanyele, Johannesburg.
Well, joining me in studio now to take a closer look at the business and investment risk landscape on the continent is Scott Nelson. He's Executive Head of Africa Practice Group, Edwin Nathan Sonnenbergs, and Anton ROUX, who's CEO of ANTON SUB-SAHARAN Africa. Thank you both for joining us in studio today. Anton, let's perhaps start off with you. I mean, you have to consider the risk that comes along with doing business anywhere in the world, but it seems that when it comes to doing business on the African continent, the risk scenario is perceived to be a lot more dire. Just how much of a disconnect are we looking at when it comes to perception versus reality?
I think there is a difference between perception and reality. I think the key issue is, as you mentioned in your introduction, is that you've got appropriate risk mitigating strategies for the geography that you wish to be in, and then that your mitigating strategy then comply with the regulations of that specific requirement. I think often investors from outside of Africa perceive the continent as one country, yet we've got different legal requirements and legal structures throughout the entire continent, and I think that's sometimes where the disconnect occurs.
That's putting the focus on proper risk analysis being done in the first place, Scott. I mean, how are businesses faring in terms of getting their risk analysis right when it comes to doing business in Africa?
I think they're doing a pretty good job, because it is something which is of particular significance in any emerging market or frontier market. Africa being obviously a large collection of emerging and frontier markets. And it's obviously an essential part of any due diligence exercise and any transaction or investment is to understand the risks, and that's as is the case in Africa. So I think it's brought into sharp focus, and people take it very seriously, and generally doing quite a good job.
Of course, that risk analysis is critical, because it would, to a large extent, Anton, inform just how savvy, how streetwise businesses are when it comes to doing business in various territories. To what extent is part of the problem business still not being country-specific enough in their analysis? Because it's all too easy talking about Africa, but it's not a homogeneous entity.
You're absolutely right. You have to get very specific country orientated. We tend to group countries together either as East Africa or Francophone. But if we just look at the East African community, Kenya, Uganda, Tanzania, there's a different regulatory environment that's taking place in each one of those countries. And we often must not see it as one homogeneous environment, and then do specific risk analysis in there, whether it's on the property side, on the liability side, or on the political risk side.
I think one of the things we sometimes see, just to sort of as a different perspective on that, is that we act for a lot of private equity funds who have who favour country concentration risk spread. So if they're putting a reasonable amount of equity check into the continent, they would rather that was spread across a number of different geographies, economies, legal systems, etc. So I totally take the point that country focus is important, regional focus is important, but also not having too much of your equity exposed to too few baskets is also something which is a reasonably prevalent risk strategy.
Helping as a mitigator against that risk, of course, Scott, when we speak to businesses who have reaped success on the continent when it comes to doing business on it, they've highlighted that bringing local partners on board is very much key. I mean, how high on the agenda should that rank as a priority for business?
I think local partners are often essential. Obviously, there's often the legal requirement to have a portion of your share capital in the hands of a local shareholder. But going beyond the pure legal requirements, I think the business efficacy it dictates that as a very sensible way to go. I think one of the things that was touched on by your interlude there was the importance of human capital as a risk mitigation strategy. I think that having the right people running your business in country is absolutely essential, and also recognising that you can't run African businesses on an expat basis. You can't just fly in people from the US or the UK or Europe or the Far East and expect the thing to work properly. You need to have good local talent. It's essential.
Of course, it's very broad talking about risk as a challenge of doing business on the African continent. So let's hone in on things a little bit. I mean, we've had the Insomnia Index report saying that political risk still ranks as the biggest challenge. So let's tackle that first. What's your view on the political risk scenario we face?
I think once again we need to look, if we look for example at this moment in time, political risk in Kenya is quite high. It's 3 months prior to an election. There's a little bit of uncertainty around what's going to be the outcome. We've got the situation currently in Mali as well, which is uncertain and so forth. But within the category of political risk, there's a number of subcategories within that. And the first one might be just expropriation of your asset or some kind of extortion. But what we also classify within political risk is sometimes regulatory risks. In other words, you do establish an operation, you do have a contract to do something, but there's frustrating elements in the contract which prevents you from executing. And that's typically a risk that you can insure against to protect the investor in a regard like that. So you may have a strategy to invest in a couple of countries, but you may take a regulatory risk insurance cover in a specific environment if that is a specific concern
Where
to
you do have that option, it's still very tricky business. Scott, I mean, let's look at a very recent example. In Zimbabwe, we've had foreign businesses like Impala Platinum, Tongaat Hewlett falling prey to the new indigenization laws that have taken hold there. I mean, a risk, a law that like that actually brings to the table?
Yeah, I mean, it does. I mean, Anton touched on a number of different aspects of sort of political or state risk, should we call it. The expropriation of your asset or knowing the stability of your asset is a key one, enforceability of contracts. I think knowing that the institutions of the state that you're sort of depending on are going to be functional as they should be and deliver the outcomes that you're expecting really is sort of the hallmark of where a country sort of goes from being challenging to being one which is sort of open for business properly. I think that more and more governments are realising that given the effective lack of any effective capital market in their own country, that attracting FDI is the only way that money is really going to come in. And to do that, you need to create a stable environment, an investor-friendly environment, which people are generally comfortable with. And I think that's a lesson that's being learned. I mean, Rwanda was cited on your interlude. We've just opened an office in Rwanda. We see that as a great example of a country that's gone from tremendous sort of adversity to economic success purely because of its attitude to the enforcement of regulation.
Anton, highlighting the fact that you've got businesses having the option to take insurance against risk like that. I mean, how do you see businesses navigating around regulatory frameworks that are shifting and just weak policy, uncertain and shaky policy environments?
Well, I mean, the insurance point is a very good one and well made, and these insurance products are there to provide a solution. I think there are a number of structural solutions that you can put in legally which give you a bit of a hedge against an adverse outcome. But the risk is always going to be inherent in any emerging market. There's nothing wrong with risk as long as the price you're paying for your investment reflects the risk you're taking. Yeah. I think making sure you've properly priced risk in at the outset is key.
Zimbabwe is a very interesting example, and Aon itself at this moment in time is subject to the indigenization bill, and we're busy with some corporate activity. But I also do need to point out that insurance cover is not necessarily always the answer. We won't find any underwriters in the world at this moment in time who's willing to write political risks in Zimbabwe, for example. So that is also a sad reality. In some of the countries, you just can't find political risk cover, Zimbabwe being one of them at this moment in time.
Mm-hmm. Trust seems to be a very big issue, and that's certainly what's been missing in that relationship between African governments and the private sector. How can we bridge that gap, and should we be seeing more public-private collaboration here?
I definitely think that public-private sector partnerships going forward is got a huge role to play, especially looking at the infrastructure need across the entire continent. But also, I think, to come back to countries like Zimbabwe, for example, there doesn't seem to be an appetite at this moment in time from the Zimbabwean government to engage on this level, which is, I think, to their detriment.
Of course, just playing devil's advocate here, Scott, I mean, there's a need to deal with imbalances that have been brought about as a result of colonial past. Are we being fair? It's got to be tricky for governments to adopt more progressive policies while addressing those past imbalances as well.
Yeah, it is very much a balancing act, and it's not being properly balanced in as many places as it should be. But you're right; those are the key issues. It's trying to look forward as opposed to just looking at the historical situation. But I think the trend is forward-looking now. I think, for all those reasons I said a second ago, that if you want to attract significant foreign capital, mm-hmm. you just have to get to a situation where people have the confidence to flow money into your country. If you don't do that, they ultimately won't. If they have their fingers burned once, they will not come back. So it's as simple as that at some level.
On that note, corruption, as far as trade and investment is concerned, it's often the elephant in the room that we don't address. I mean, to what extent is this an issue? Is it something that's deterring investment?
It's not necessarily deterring investment, because you find out, inevitably a due diligence will the reality is turn up, elements of likely imperfect business behaviour in a lot of places. So you just need to figure out what is being done, and you need to sort it. I mean, you can't, particularly given the overseas legislation in the US and the UK Bribery Act, that there is just no option for large institutional investors to put money into a scenario where there's any suggestion of corruption or facilitation. So, as part of diligence, you will unearth anything that is going on, and then you will just need to put in place systems and measures to eradicate it. And that is, so yes, it's there often in varying degrees, but the key is just to find out about it and then resolve it.
Well, let's hit pause on the conversation for now, at least. After the break, we'll be getting more on Invest Africa and looking specifically at the risk scenario on the African continent. That's when we come back, so don't go away. Welcome back to Invest Africa. Still with me in studio to unpack business and investment risk on the African continent is Scott Nelson. He's Executive Head of Africa Practice Group Edwin Nathan Sonnenbergs, and Anton Roux, who's CEO of Aon SUB-SAHARAN Africa, with us as well. Gentlemen, let's get back into discussion. Anton, just before the break, we were looking at corruption and to what extent that's acting as a deterrent to investors. Scott highlighting that the onus is on business to know the environments within which they operate. Having said that, when it comes to types of business risk on the African continent, though, we're looking at business fraud, corporate kidnapping, transport and freight, hijacking. It all collectively plays a role here.
Absolutely right. It's a package of a suite of mitigation factors that need to be put into place. I must just say that on the corruption side, I often feel that corruption is overplayed on the African continent. In my experience in traveling and in dealing in this continent over the last 8 or 9 years, I have very seldom encountered it, and very seldom in a corporate environment actually encountered it. I'm not saying it's not taking place and that it is not a risk, but certainly with your OFAC rules and the things that all corporate entities and all foreign investors are putting into place, I think we've made some dramatic improvements in the continent over the last decade.
When it comes to this environment within which businesses operate, of course, there's increasing competition as investors get lured to the potential that Africa's putting on the table. And cited as a risk factor is that increased competition itself, Scott. I mean, on the agenda is the ability, for businesses to enhance their competitive advantage. Labour, from a cost perspective, from a productivity perspective, gets put in focus as well. How are we doing on that front?
There is obviously, Africa has been very much, I think, flavour of the month for many years now. I think, as the developed markets have found it difficult to provide returns in sort of pre-2007 levels, then we've seen a tremendous influx of and sort of refocusing of capital away from those traditional markets and onto the continent, which is definitely sort of fueled prices and increased competition for good quality assets on the continent. I think one of the things that is key to doing business in Africa, and it goes perhaps back to the sort of local partner concept, is sort of the importance of proprietary deal flow, the importance of having visibility and opportunity. And I think a lot of sort of perhaps the newer entrants to the market have had a degree of difficulty in sort of having access to that opportunity in the way that they would do in their more established backyards. And if you're a large corporate or large institution and you're operating in North America or Europe or the Far East, you're just used to seeing the opportunity because you are a large institution. Mm-hmm. There's a much more entrepreneurial environment on the continent, and even some very large transactions or opportunities can literally be done and gone to those who have that line of sight on the opportunity ahead of large institutions. You may have seen this, and obviously it's different dealing institution to institution, but if you're looking at sort of acquisition opportunities and those kinds of things, you really need to have access to the deal flow, and I think that's been quite an interesting experience for a lot of the new entrants in the market.
Talking about access to things, what about access to infrastructure? Is infrastructure supportive of business? What's the risk associated with infrastructure as you see it? Not just the state of infrastructure, but the cost of that access where it is available.
I think that's often misunderstood in the day-to-day running of business are the limitations in the infrastructure. The infrastructure do exist, but don't try and make a comparison to infrastructure in the developing world. In Africa still, it is difficult to travel by air from west to east and east to west, and we've only got 3 hubs on the entire continent. So things can get done, it just takes longer than what most people actually anticipate. Yeah. But the infrastructure is incredibly developed. What people don't realize is that you can drive from Cape Town to Cairo on tar roads. And we've done that, for example. So it's not that there's no infrastructure, but it is not accustomed to what you might find in Australia or in Europe or in the USA.
Of course, there's the cost element to consider as well, and the kind of cost pressure infrastructure burdens place, or infrastructure places on companies, the cost pressures that access to labour places on companies as well. Scott, what's the role of government as you see it in alleviating some of these cost pressures?
I think it comes back to sort of engaging actively with with the businesses and the investors in the country. I think Anton mentioned that certain countries are doing a better job of that than others, and there are certain countries where you can have that active debate and certain where you presently can't at the moment. Mm-hmm. But I think that a good, healthy, active debate with the private enterprise in your country and seeking to support these the things that underpin the economy and improving infrastructure is definitely one that will be of huge assistance. You look at the statistics on GDP growth in Africa and how many of the countries in Africa are going to be in the top 10 of the fastest growing economies in the world, and they're all doing that with a fraction of the infrastructure you would generally require. So it's quite amazing.
Yeah, I think from an investor point of view is if you want certainty in the regulatory environment that you're in, it's not that it needs to be necessarily a friendly regulatory environment. There might be some issues in there that you disagree with and find discomfort, but what is more uncomfortable is a regulatory environment that changes at short notice without proper consultation.
Absolutely. I mean, just looking at some of the other risks that have been identified by Aon's risk management survey, Anton, if we can go through them. I mean, the survey seeing 2 new risks entering the top 10 list: failure to innovate and meet customer needs, and then technology and system failure as well. That's pretty interesting. Give us some detail on those.
I think the big issue in Africa is from a technology infrastructure point is the lack of connectivity from a technology point of view. We're still paying incredibly high prices across the entire continent for internet bandwidth, and it's improving rapidly on a month-to-month basis. But that is a huge cost, and as a consequence of that, you may have something that works in the environment that you're familiar with. You get to a place and all of a sudden it doesn't work anymore. And as the world moves more to a globalization or cloud computing and so forth, some of these things just don't work necessarily, and not because there's a problem in the technology, but there's a problem in the connectivity to that. So I think that's a fairly significant risk factor, and the failure of those technology solutions or solutions that you want to deploy in the environments that you're investing in.
It sounds like it's something that's key to focus on, Scott, because if things go wrong down these roads, I mean, failure to innovate and meet customer needs, and if you experience technology and system failures as well, it could lead to the damage of a reputation or brand, and that could have longer-term implications for the business itself and its profitability moving down the line.
No, sure. When you take your brand into an African country, as both Anton and I can attest to, you need to make sure that you're not going to have a bad experience, and all the things you've mentioned potentially expose you, and you need to be comfortable that you've got the tools to do business with. And
to a large extent, though, it boils down to changing strategies appropriately. Is enough emphasis being placed on, adapting in order to survive? Because more often than not, we have seen in the past businesses employ a copy-paste model of their businesses on the continent.
No, you can't. You can't. Again, we said this is a continent of many different countries, cultures, legal systems, etc. You can't just assume that one approach in one country will work in another country, and far from it. I mean, the importance of understanding the local drivers and dynamics in each market, and not assuming that it works the same way as it does in South Africa or it does in another country is absolutely key. That'd be a very, very poor mistake to make.
Absolutely. Well, let's get into what businesses can do, moving down the road a little bit more effectively, because what the uncertainty and increased focus from regulators does is it really draws into focus for businesses the kind of risks that they do face doing business. So, tips for businesses going down this route?
I think we've used the term local partners quite often.
Yeah.
The term that I personally prefer is one more of local knowledge. You may not necessarily have to have local partners, but you certainly need local knowledge of customs, of languages, to deal with those items on a day-to-day basis, would be my first point of advice. Do your homework on the cultural side and an environment as well, and understand that. It is very difficult from operating in Angola versus Zambia, for example. Yet the countries is in the close geography and proximity to one another from a language barrier point of view. The second issue is the issue of and the utilization of expats. In some of the environments, there's fantastic investment opportunity, but you're going to need a certain amount of expats to get these businesses going. And I find that there's very often a disconnect between what you can do and what you can actually practically do once you've made the investment. Some countries, for example, have got ratios where for every one expat that you employ, you have to employ 9 local citizens. So it's issues like that which should not be underestimated when you do that. And then, of course, where you've got a mitigation strategy, put the proper insurance policies in place to mitigate against those risks in the event of things going wrong.
You highlighted the importance of human capital a little earlier, Scott, yes. And one of the risks that crop up on your top 10 list of risks at Aon is failure to attract and to retain top talent. What are businesses doing wrong? What should they be doing to get that, get that right?
The talent pool is smaller, so clearly that is a factor.
So that's a big challenge.
That's challenge number one. So I think that that's your first problem. So the second, the flows from that as I said earlier, I think the importance of having good local talent is fundamental to your returns. If you look at the sort of the M&A or private equity market in this continent, it's radically different from the developed world, and one of the key differentiators is the pricing of assets and the generation of returns, which are not generated so much by leverage. You make a return in this country, on the continent, by making a business better, and the way you make a business better is to have, amongst other things, but importantly, is have very good management who can run it and improve it.
Yeah, well, let's leave it there, gentlemen. Thanks so much for having joined us today, and that's where we leave it for this edition of Invest Africa. Thanks to my guest today, Scott Nelson from ENF.